The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and/or through separate funds and may change their holdings at any time.
Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everyone, to a new episode of This Week in Intelligent Investing. Elliot and I are truly excited and honored to have with us today a special guest, Christopher Tsai, President and Chief Investment Officer of Tsai Capital Corporation. I'm sure most of you listening today know Christopher by now. He is a wonderful mentor and contributor to the MOI Global community and the investment community broadly. Christopher, such an honor to have you. Welcome.
Thank you for having me here, John. Thank you, Elliot. And it's truly my pleasure because I've known you guys for so long now. And I think this is going to be just a great conversation between friends.
So, Christopher, you gave a wonderful talk, Investing in an Age of Disruption. And I think we're going to talk a lot about that topic in this episode. Maybe just as a starting point, how did you get interested in disruption, in investing in those types of businesses, and maybe feel free to kind of go back a little bit and tell us about your path as well.
Sure. Investing in growth companies has always been interesting to me, especially businesses that are at the forefront of change. The problem is that as a value investor, often these kinds of companies look expensive. So I wanted to come up with a framework about thinking about disruptive businesses and their valuation in a way that made sense to me. During that thought process, obviously, many thoughts came to mind and a lot of research over many years. Eventually, actually, because of you, John, this talk was really born. I first gave it at Latticework, and it expanded somewhat to its present form, which is a result of the talk I gave at the Zurich Project Conference in June of last year. So this is really about thinking about investing in disruptive businesses, but with the eye of a value investor, as opposed to somebody who might be approaching it from a different angle.
Exactly. So when you say with an eye of a value investor, I assume you are referring to valuation also being a factor in the analysis or in the types of investments you seek to make?
In every investment, what we're trying to get, as is, I believe, every member of the MOI community, something worth more than we're paying for it. That's unfortunately, though, not so easy to do. Otherwise, everybody would be a lot more wealthy than they are, right? And when it comes to investing in high growth businesses, what I learned I've had a couple of really great mentors over the years. One was my late father, Gerald Tsai, who started out his career in the investment management space, only in the growth company space. And another mentor of mine was somebody, and his name is probably familiar to just about everybody. His name is Ron Barron. And both my late father and Ron taught me a couple of useful things. My late father said, "Look, there are no shortcuts to trying to uncover what a company is worth. You really have to do the work, the deep dive, and try to understand what the profitability of the underlying product or service is." That's another way of saying, you really have to try to figure out what are the economics, what are the unit economics of the business. And I'm not talking about like customer acquisition costs or lifetime value or all of those metrics that I discount in many ways. But I'm talking about a very simple unit economic measure. So if we're thinking about, let's just think about McDonald's or Coca-Cola. You sell a can of soda. What is the net income per can per share? If you're running a McDonald's franchise, what is the net income per restaurant per share? And so I use that approach to think about looking at disruptive companies, fast growing companies that might be investing very heavily now, penalizing earnings now to create a higher intrinsic value later. So both my father and Ron Barron had this lens through which they viewed high growth companies. That lens being not to dismiss a company because its valuation might look high, but to do the deep work and to try to figure out what's going on underneath the hood.
Yeah, I thought that part was super interesting because value investors tend to be very allergic to this notion that we should think about valuation in new ways. But you're really talking about, like, at the end of the day, business fundamentals, what a microeconomics analysis of a business looks like. And you also tied it seems like you have a special attraction to companies that are driving down unit costs along the way. So not only is that cost per can that Coke's getting, something that but or the revenue per can, but the cost keeps going down. Maybe talk a little bit about how you think about the feedback loops and what drives even better economics as these companies scale.
Yeah, well, that's the point you just touched on is so interesting, particularly with rapidly growing companies. I got interested in looking at these businesses in different ways as a result of this quote I came across by Marcel Proust. Marcel Proust, for those who don't know who he is, he's this monumental French author who wrote a book called In Search of Lost Time, which is multiple volumes. And he has this way of just like capturing what's going on around him and really understanding human behavior. But there was a line that I came across, and he said that the real voyage of discovery was not in seeking new landscapes, but in having new eyes. And I thought, well, how amazing is that quote? Like, this can be applied to so many aspects of investing. So when it comes to growth companies, how do we think about looking at growth companies with new eyes? Elliot, you alluded to thinking about driving costs down. And I think Nick Sleep spoke about that and picked up on that very, very early with his investments in Costco and Amazon. This idea of scale economy shared, the idea of creating more for the customer than other companies might necessarily do. Another way to phrase that is, as a company scales and drives down its cost per unit of whatever they are selling, instead of pocketing the incremental margin that comes from scale, maybe give some of that back to the consumer in the form of lower pricing, a higher quality product, or a combination of those two. And so Nick and Zach picked up on that very early. They coined this wonderful concept, scale economy shared. They applied that with their investment in Amazon, in Costco, and perhaps in other businesses. And that's what I'm looking for in disruptive growth companies. There are actually not a lot of them who operate with that kind of philosophy, which I think is a true win-win framework, a framework that creates durability in growth. And it's a framework that creates a solid foundation, an economic moat on which businesses then can compound capital for their investors over a long duration. And I think that's what it really comes down to, finding these great businesses that are misunderstood, that don't screen well, that might offer value where others think that value doesn't exist, and being able to compound along with a management team that's truly aligned with their shareholders and truly aligned in creating that win-win framework.
I love that you could invoke Proust in this. It's amazing. And, when I think about some of the challenges I've had in disruptive areas, and you referenced it, some of these companies have to invest pretty heavily up front in order for the opportunity to truly take shape. But that means they also have to be right to a degree about how the market grows and how they're able to capture, like, the pace at which they're able to capture share in the market. So how do you think about making sure, some of these companies along the way, I've spoken to some operators recently who are like, yeah, we got over our skis. We invested a little ahead of the opportunity, and so we have to pull back spend. So how do you think about balancing those risks? I'd imagine management alignment is part of that, but balancing those risks and getting a sense for when you actually grow into what might be in more traditional frameworks, a reasonable valuation.
Yeah, well, first of all, to preface that, the idea of disruptive companies can be thought about in different ways depending upon what perspective you're coming from. And so by that, I mean, each person might have a different definition of what a disruptive company is. I am not interested or don't have the stomach for profitless enterprises, just to be clear. And disruption often falls in that category. The dictionary that I use defines disruption as a break or interruption in the normal course of things. So when I use the term disruption, I use it quite broadly. And I'm thinking about businesses like Costco, which I find to be hugely disruptive, and businesses like Nike. I'm not thinking about companies that are profitless just because we don't, the more conservative client base that we have. So with that being said, when I think about risks, Elliot, to answer your question, I'm thinking about aligning myself with a management team that has a record, a stellar record of allocating capital to new business ventures or in a new direction in a way that makes sense for the business overall, so that if there is a mistake, if there is an assumption that something will play out to a certain degree and it doesn't, that the rest of the business is not put into jeopardy. So we take a pretty conservative approach when we're thinking about investing into disruptive areas, and it perhaps might not align with how other people think about disruption. People, the management team, these things are hugely important in terms of reducing risks. And we want a management team, we want an employee base that is all in. And when you have that kind of fabric to your business, a culture where the people are all in, I think that risks come down a lot, and upside becomes much greater than anybody might imagine in the beginning. And Peter Kaufman speaks all about this idea of being all in, and the idea of 2 + 2 becoming more than 4.
Yeah, I love that you point out companies like Costco and Nike, because they are ones who've basically taken existing markets but come forward with a completely different approach, whether it be a business model, um, the actual product itself, an association as a member. And so, like, a lot of people think of disruption more as creating a new market. And I know you spoke a lot about Apple and how it was misvalued along the way. Like, they created a market, no one really knew how big it would be, even if, like, they obviously disrupted the Walkman at the time, or the Discman, if you will. Um, but yeah, how do you think about the contrast between disruptive companies that create markets versus those that are like taking on existing markets and capturing their own piece of the pie?
Well, they're both interesting because if done correctly, tremendous shareholder value can be created, and tremendous shareholder value can also be destroyed. And so that's the interesting thing about investing in an age of disruption, which is today, and it's been that way for some time, that so much market value can be created, but conversely, so much market value can be destroyed. And so you could be you could be living in your own world, doing your own thing. That world being, um, you know, you might define yourself as a value investor who likes low multiple companies and high dividend yields, and et cetera, and you don't want to have anything to do with what we're talking about today. The problem is that you're not an island, and disruptive companies come along and they can eat your lunch. And so this talk that I originally gave at John's Lattice work, which then was expanded for a version that I gave at the Zurich project, mentioned Dollar Shave Club as a prime example of a disruptive company which successfully took on Gillette. And Dollar Shave Club was founded in 2011. And its disruptive approach was to use a direct-to-consumer business model that became like so popular and so powerful that it was able to breach Gillette's once unthinkably breachable moat. And it did it only after 6 years since the company was founded. And consequently, Gillette lost market share, and they had to cut prices of their razors initially by 12%. And so that was the company that I used as an example, besides Apple, as one that was hugely disruptive. In the Dollar Shave Club, it was disruptive to an existing business. In the case of Apple, Elliot, I think it was disruptive in the sense that it was creating an entirely new market, in a market that nobody knew was needed and nobody knew existed. I'm reminded of Victor Hugo, who said, nothing is more powerful than an idea whose time has come. And that was the situation with Apple in 2007. It just wiped out the existing smartphone market, and created a whole new one. And we did not know really what was to come of it and how dependent we would be on the new technology. But the idea was ripe. It was powerful. It's the time had come, because in 2007, as is the case with disruptive technologies, you have convergence. And in this case, you had the convergence of various technologies that were needed to launch the iPhone, including touchscreens, processing power, the sensors, right, that are part of the phone. Energy dense lithium ion batteries. Like, all of these things didn't exist before, and certainly not together. And this was a moment in time where they all did come together and created these massive positive and causal feedback loops.
I'm curious, Christopher, how you view Apple today. In some ways, it seems like the ultimate incumbent. Do you think they're still a disruptor, or are they more likely to be disrupted?
Well, I don't have, of course, a crystal ball, and Apple is one of our top 5 holdings. And we first bought Apple at the end of 2018 or so, after there was a massive sell-off in the stock for a variety of reasons. So we own it today. Our cost basis is much, much lower, and our accounts are mostly taxable. So it's still in the portfolios today, and I'm positive about the future of Apple. But I'm positive about it for a different reason. And I don't think that the growth of the company will echo the growth of the past 5 years. Whether it's a disruptor, or is primed to be disruptive by some new business or business model, that remains to be seen. And all of this, of course, is, as an investor, right? It's everything we think about, the risks and the possible upside. It's all in the context of valuation, right? So with Apple selling at 25 times earnings, roughly, I think that it's balances the potential upside with the potential risks of the company maybe being disrupted in some way.
Yeah, that's really interesting on Apple. I mean, it's This Week in Intelligent Investing here. This is the week that the government finally came after Apple with antitrust, and that shows a lot of how far they've come since you first bought it and since Buffett first bought the company. And it's also at a time when, like, AI is the topic on everyone's minds, and so Apple seemingly might be developing a partnership with Google and then Baidu separately in China to push AI forward. And it seems like disruption could be the kind of AI could be the kind of disruption that Apple has risks from, but also can leverage uniquely with their ability to distribute it. How do you think about AI and the risk for some of these companies? Is this a new thing where you're like viewing your disruption paradigm any differently?
I love that question, Elliot. Before I tackle that, I just want to say 2 things before we move in that direction, because I think it will be helpful to frame the conversation about AI. The first is that as businesses become more powerful, and I'm referring to Apple in particular, you have potentially these antitrust concerns that you brought up. But I'm just reminded of, Google going through a similar issue in the past, and how that has not hurt the growth of the intrinsic value of that company. And if we look at it perhaps from the lens of the early 1900s or so, or going back 100 plus years, and we look at Standard Oil, I'm not sure a lot of people realize how much value was created when Standard Oil was broken up. So while this idea, the headline risk of, you read antitrust, issues or potential breakup or all of these things, you read it in the press, and the initial reaction might be a knee-jerk reaction that, hey, this is bad. But I just caution people to think about the other side of the pancake, so to speak, right? There might be something very positive about breaking up a company. And so when I think about how we manage portfolios, we have 21 or so positions in the portfolio today. And the reason why we might have more than some other investors within MOI is because I truly, and we might have less, but I truly feel like you need to have a nice number of companies because so many businesses are in fact being disrupted. And in order to truly drive alpha and participate fully in the growth of a compounder, businesses are going to go through rough times. They all do. There's always going to be some concern, some reason to sell, something you hear from another friend or a smart investor, or something you hear at a cocktail party. There's always going to be a reason to sell. And so if you have more positions than fewer positions, you're able, at least in our case, we feel we're able to hold on to these companies and ride through potentially rough times and allow these businesses to truly compound for us. And that brings us back to AI, your question on AI and the threat or potential benefits that AI brings. And I feel that it's so early in the process. I feel like we have a number of companies that can benefit from AI, but I feel like maybe some of these companies might be disrupted in some ways by AI, and it's just too early to tell.
Yeah, I think we could talk more about AI as we go, but I think you made a really interesting point on the antitrust side, Standard Oil and the history there. I really looked at AT&T pretty closely as an example of where incredible value was created by taking what had formerly been a very bureaucratic organization that took its position in the market for granted because they were so damn dominant. And you had dynamism injected, creating like very new kinds of opportunities. So I guess one of the things I've been debating in my own head about where this is going with antitrust is, might it have very different ramifications for different kinds of companies and culture? When you think about Google, this might be relying on conventional wisdom a little too much, but Google seems like a sleepier organization that's a little complacent, that maybe cuddles employees a little bit and doesn't move quickly. They're definitely not a move fast and break things kind of organization that spends on these wild bets where you have no clear sense of return. And Apple is one where culturally, like, it starts with the hardware and software being tightly integrated. They're super secretive, very quiet. They don't really make wild bets, run it tight to the vest. Like, could that have very different consequences for the cultures of the two companies?
Yeah, for sure. I think that's a great point. And I think it's also very hard to know. Like when I think about these things, I am always drawn back to this idea of iatrogenics that comes out of the field of medicine, where the idea being like you might operate on a patient for something to fix that problem, but by accident you create a problem somewhere else. And I think that the same thing happens with companies, and it depends on the structure of the business and the size of the bets that they take. And I think there are often unknown ramifications. I'm not answering your question directly, but I think that ultimately, a lot of this is in the unknown. And that's one of the reasons why we like to have some diversification within the portfolio so that we can ride through potential periods of concern for our business and not get so emotional about feeling the need to maybe sell right away, whereas other investors might have that feeling. But what I think is true in all cases in the types of businesses we're talking about, being Apple or Google or any other kind of business, being younger or older, I think that, and I mentioned this in the investing in an age of disruption talk. One thing that is constant, and I truly believe that there's some physics here that's applicable, specifically the second law of thermodynamics. And within that law, we learned that there's this loss of energy, right? It tells us the second law tells us that all closed systems lose energy, and this loss of energy is called entropy. And I think that ultimately entropy is what kills large businesses. And you mentioned about, Elliot, you talked about complacency, and I think these are the things that kill large businesses. And we have to see like how quickly Apple and Google adapt to a changing world. But large is definitely, size can bring some complexity and can lead to complacency and eventually downfall.
Christopher, how do you think about holding periods? You just mentioned being able to ride through tough times with your investee companies. Clearly, you see yourself as a business investor and partner to those businesses. So how do you think about the sell decision in a way?
That's always the trickiest part, I think. The investors that you and I admire, John, and you and I admire, Elliot, probably all have said that the biggest mistakes that they've made were selling great compounders too soon. John, you were so kind to arrange for this fireside chat that I gave at Lattice Work and asked me to invite whoever I wanted to speak with on stage. And so I called Peter Keefe, and Peter came to New York to do this fireside, and it was a wonderful conversation. And he was asked this question, and his answer was, we sell when the compounders no longer compound. And I kind of think about it the same way. And if I dive in a little bit deeper than that, what does that really mean? It means when a company is no longer creating intrinsic value for its shareholders. And that is a very, very hard thing to kind of discern. And it's one of the reasons why I like to align capital with management teams that have had a proven track record. And I have a kind of this idea that they will figure out how to weather the tough times, which are inevitable for every growth company. The other time we sell is when we think that we've made a mistake. So I try to be very, very quick in selling out of a company if I think my initial thesis was wrong. And again, we'll sell when the business is no longer compounding. And by that, I mean when the business is no longer creating intrinsic value for its shareholders. And that typically means when the fundamentals of the company are deteriorating in some form or another. So those are my two sell criteria: deterioration in fundamentals that lead to the halting of compounding, and when I think that the initial thesis was wrong. What you'll notice is that there isn't a third reason. And the third reason is often, when the company becomes too expensive. The problem I have with number three, and we don't sell companies when they become overvalued. The problem I have with number three is that all great growth companies become overvalued at some point in time, and typically often. And in order to fully enjoy the compounding of those companies over many years, and not get caught up in the idea of thinking that you are so much smarter than the market and that you could exit and go back in, and there's not going to be an emotional component at some point that prevents you from going back in. We just avoid number three altogether. This notion of selling when we think it might, when the market value might exceed intrinsic value by some percentage.
So that's something that I've struggled with like intensely during these last few years because
it's hard. So hard.
Yeah. Yeah. And then, how do you know when it's something that's fundamentally changed versus something that maybe just got a little ahead of itself versus something where, maybe you should be re-underwriting it and thinking a little differently about the business from where you'd started?
Yeah, there's no like, there's no magic playbook. Every business is different. I will say, though, that I do give businesses that are run by stellar management teams that have had a proven track record of allocating capital and creating more than $1 of market value for every dollar of retained earnings, some benefit of the doubt. And I do give businesses a few years to weather rough periods. And if you look historically at the trajectory of growth companies, just take a stock chart and look at any growth company, you will notice something. You will notice something that mimics the pattern of the overall stock market. And you will notice there's a step-like pattern. In other words, there's this growth period, and then stocks go sideways in some shape or form for a period of time, and then they resume an upward growth phase, and then they go sideways, and they have this kind of step-like pattern. If you look at the S&P 500, incidentally, going back to, you can go back all the way to 1929. And Vitaly Katznelson shows this in one of his books. You see that the market moves in like 16 to 18-year periods in a step-like format, and that's no different from growth companies. So I like to give growth companies the benefit of the doubt that are, these businesses that are run by great management teams. And I like to, see how they might perform through a rough period for a few years before doing anything that might be rash. No magic formula.
Yeah, no, this is one of the things I'm really I don't know, toying with myself about. But do you think it's different for a company that's not exactly mature, but more mature like Costco than an earlier stage growth company who's just hit the market kind of hot? And
well, yeah, I mean, so what makes it easier is the question. And is it easier because that if it doesn't work out, the stock is not going to zero? Or might you make it easier in an earlier stage company by perhaps having less capital invested?
Yep.
So you can create a situation where your emotional equanimity to a particular sell-off is mitigated through the fact that you might have a position that is half the size of a more established company. That's the way I think about it.
Professor Sanjay Bakshi had this notion. There was a presentation he did like a decade ago, I think. He talked about returns per unit of stress. And I think that's almost exactly what you're getting to there in some ways.
He says it much more eloquently than I just rambled on about, but that's how I think about it.
Right.
And that's why we have 21 companies, because we can have some younger stage companies. By the way, younger stage for us is like they've been around for a while. They just might not have been around for 20 years, or 30 years. But we can have some younger stage companies. We can have some more developed companies. We can have some smaller market caps. We can have some larger market caps. And we can ride through these periods that are inevitable to be rough from time to time.
So when you think about diversification and being able to I'd call it a kind of barbell in your book where you have like
There you
younger
go.
and older
Exactly.
companies. Yeah, it's nice both that you're mentally flexible enough to do that, right? A lot of people might say I want one or the other, not both. But do you have like discrete expectations for what portion of your portfolio should be allocated to each at any given time, or is it more like your portfolio is an output from what companies you find interesting?
Our portfolio is truly a function of risk um, and potential upside and the quality of the underlying business. But that being said, if you were to pull up our 13F and look at our holdings, I think you would agree that the 21 or so companies that we own, whether they might be smaller um, or very large, they all are of exceptionally high quality. I think that we own some of really the highest quality companies on the planet. And they're not without their own problems because they'll all have problems from time to time. And, and I think John and I are on the same wavelength with respect to Alphabet, right, John, about the potential for disruption through AI to Alphabet's model.
Sure.
But we own Alphabet, and it's we've owned it for a long time, and it's still a high quality business, and we monitor it because things change. I mean, half the companies in the Fortune 500 have either gone out of business or have been acquired over the past 24 years or so. So whether you are in a disruptive business or in a more traditional business, don't forget that statistic that half the companies in the Fortune 500 have either gone bankrupt or have been acquired in the past 24 years. So that's something to really consider.
And Christopher, we talk a lot about companies here. I'm wondering how you view the importance of management teams, because with a lot of these types of businesses that are disruptive, there's often a one driving force behind that business, perhaps the founder, perhaps somebody with a large equity stake.
Yeah.
So, talk about perhaps the companies where you would seriously consider selling if the main CEO operator were to leave.
Yeah. So let me preface that by saying that I was very fortunate to grow up surrounded by CEOs. And so what do I mean by that? My late father, Jerry Tsai, had this long history on Wall Street. And as a result of his connections, I was able to meet a lot of CEOs very early on, starting in I guess when I was 11. I met a gentleman by the name of Donald Kramer who ran a company called Nacre. Nacre was the first stock that I ever bought when I was 11. Bought 5 shares at $20 a share. That's all I could afford. But it was very interesting to see how he operated. He spoke to me a lot about his business, which was reinsurance. I was fortunate to meet other businessmen like Larry Tisch, who was my sister's godfather. Norman Alexander, who ran a company called Sequoia, which was sold eventually to Carlyle. And I think it's pretty timely for me to mention that I also met a gentleman by the name of Brad Jacobs very, very early when I was still at Middlebury College. And Brad went on to launch multiple companies during his career, including United Waste, United Rentals, Express One, of which I was one of his 20 or so early investors that took control of Express One, which became XPO. And so I mention all of this because I watched people increasingly over the years, and I've watched how they operate, often in very different ways. But what I learned in all cases is that the the guy or the woman at the top really, really makes a lot of difference. They just There are certain people that you just want to align yourself with them. You spot somebody that is different. It might be an unconventional person, but some people just are unique in their ability to pull rabbits out of hats and create enormous shareholder value. And you want to align yourself with those people. So it's a long way, John, and it's a long way, Elliot, of saying that like people are hugely important. I did not realize this until later in my career, and it's something that my mentor Ron Barron has spoken a lot about. This idea of people, this idea of culture, um, hard to create, hard to replicate, and certainly an intangible element, a piece of the moat, if you will, that can be massively underappreciated. So it's a long way of saying I try to align our capital with CEOs that I truly believe in and feel like they are aligned with my capital. Just today, just before we jumped on this conversation together, guys, I was just chatting over text with Dennis Hong, and Dennis and I were chatting about one particular company, and I said to him, you got to watch the speech the CEO of this company gave, because once you watch this speech, it's very clear, like, you do not want to bet against this person. This person has gone through hell and back. He fought his way to where he is today to build this remarkable business. And that is somebody you don't want to bet against. That is somebody you want to align yourself with. And so it's one of our 21 positions. So I love trying to figure out who those people are. And then to your question, John, like, what happens when they may no longer be there? Well, then it's a question of like who's stepping in, and how developed is the business after this person, at the time this person might leave. But going back to Peter Kaufman, Peter has written this remarkable essay on regression to the mean, and he talks about remarkable people leaving, specifically about this point. And Peter's point is that, look, when somebody remarkable, a fanatic, an intelligent fanatic, leaves, there's typically regression to the mean. So we need to keep that in mind as well.
So, like, I guess one of the interesting things on that front, you mentioned Brad Jacobs, and I think with any key man risk, if you will, like, there's two kinds of people. I'm being extremely binary about this, but there's some where they are the cult of personality the business is built around, and they don't really build robust processes or human capital around them in order to facilitate smooth succession. And there are others who build phenomenal operations and bring in excellent people, highly competent people. And I think it's notable that Brad's companies not just didn't suffer, but like excelled after he left them as well. It might be the biggest hallmark of someone truly phenomenal in some ways.
Well, yeah, absolutely. But to add some color there, because I'm very familiar with the companies Brad has been involved with. My father, incidentally, was one of the original investors in United Rentals. If I remember correctly, there were just five guys who put capital in to start United Rentals. I might be wrong on the number, but it's very, very, very few. And when Brad left United Rentals, Brad put Mike Nealand, who I know, in charge of United Rentals. And Mike is a phenomenal CEO and a great capital allocator. And we can see that by what he's done. But Brad certainly has a knack for choosing the right people to not only be involved with the companies that he is currently head of, but he's also able to kind of structure a management team for a time when he might not be running the company.
It's fascinating also when you think of examples like Apple. I thought when Steve Jobs passed that, Apple's best days were over. Similarly for Microsoft, reaching new heights now. There are other examples. Amazon, with Jeff Bezos departing from day-to-day operations. I also was skeptical. So it seems like those companies, when they get to a certain point, they typically have a pretty deep bench. So is it more that with smaller companies that issue is amplified? How do you think about that, Christopher?
I have not gone in and kind of done a deep dive analysis of what happens when CEOs of small companies depart. But my general sense is that, at least for me, I would be more comfortable, obviously, in a larger company that has a deep management bench if the CEO were to depart. And maybe we should keep what you just said, John, in mind as the management team of Berkshire Hathaway continues to age. And maybe we should not assume, as I think many people do, that Berkshire's best days are behind it or will be behind it when Warren passes. Perhaps its best days, or good days at least, are still ahead.
And that's one of the virtues of decentralization, right? I mean, they centralize capital allocation, but the rest of the businesses each have super competent leaders. And I was going to ask you anyway, so I'll tie it into this, but this idea, like decentralized conglomerates, you think that's a interesting way to be on both sides of disruption while ensuring durability at the same time?
I think it really depends on the management team. In other words, there are cases where you just have a particular CEO at the helm, and you wouldn't want anything different, in my opinion. And so, one example, at least to me, one example would be Meta, for example. I mean, Mark has shown himself to do what it takes to create shareholder value. And so what I want, the various areas in Meta to be decentralized, and we don't own Meta, but I'm just thinking out loud as we're talking. Would I want to have somebody else calling some of the shots instead of Mark? Probably not. I think it depends. It depends on the business, and it depends on the type of company.
Isn't it amazing to think a year and a half ago, maybe, years too soon, year and a half ago, people were calling for Mark's head?
And that's my point about all companies go through rough periods. If you have trust, explicit, trust in that the CEO will do the right thing, then I think that makes it a lot easier to hold compounders through challenging times. And it makes it easier to do so when you might have 21 companies like we do, as opposed to just 2 or 3. I mean, think about it, how hard it would be, Elliot, if you were managing money for others and let's take an extreme, you only had one company I mean, think of how hard it would be to hold that company through a challenging period, emotionally and practically. Just almost impossible. So it'd be very, very hard to enjoy the full benefits of the compounding, let's say, of Netflix if you only owned Netflix. I mean, how many drawdowns of 60, 70% has Netflix gone through since its IPO? And how many people have actually held through those drawdowns? Probably not many.
Yeah, it's interesting. I started in this business on a trade desk, and one of my mentors there always said, like, your foremost responsibility is put yourself in a position to see your best ideas through. And what he meant by that is
I
you
love
do
that.
not
Love
want
that.
to, right? It's so
Love that.
simple.
Yeah.
Yeah. And your best, I mean, your best ideas are the ones where even when you're taking that immense pain, you never question your resolve.
Yeah, and
Um,
and you got to set yourself up though in a way so you don't have to go back to go, right? You don't want to lose a leg along the marathon.
Yeah, it's so interesting. Like, live to fight another day matters so much in this, and the psychological management of it all matters so much. So, like, diversification, I don't think many people, like, I guess partly because of Munger and Buffett's influence, but a lot of people in the value investing world don't talk that much about diversification.
We
But
should
it really
talk
does.
about it. We should talk about it because I think it's so important.
Yeah. So maybe diversification, right? So number of positions is one way to diversify, but how else do you think about it? Do you think about trying to get into a certain number of industries? Do you look at the correlation amongst and between your positions? What other factors might play into thinking about diversification and building a portfolio?
Well, before we get to perhaps the forms of diversification, maybe we can spend just a few minutes on the notion of diversification in itself. And I mentioned diversification specifically in the Investing in an Age of Disruption talk that I gave at John Zurich Project, because it was one of the three central points to the talk. And I said that we should use diversification not only to play defense, but also to play offense. And I specifically said that we don't need what I would consider to be a badass, let's call it three stock portfolio to outperform the market. And what did I mean by that? I meant that, look, there are going to be periods when there are massive market sell offs, right? And in periods when markets sell off, certain companies that might be on your wish list, quality companies, might get beaten down to valuations that are really, really attractive. And let me frame that. It might be a situation where, you think there's 20% downside and 200% upside, just hypothetically. And let's say that the rest of the portfolio, because of the market sell-off, got beaten down as well. And you feel like pretty much averaged out. The rest of the portfolio has 20% downside and 200% upside. So my point of the talk is, like, why not add in a few other companies to the portfolio, quality companies that might have been on your wish list, and diversify out a little bit? Why not, in other words, play some offense by planting a few more seeds that can sprout into multi-baggers? So that's how I think about diversification, that it does not need to dilute the future potential return of the portfolio if done correctly.
I love that idea that you could play offense with it. Like, there are more ways that things could go right for you with more positions.
Absolutely. And this is because there's asymmetry in growth. And keep in mind, we've established statistically that half the companies in the Fortune 500 have either gone bankrupt or have been acquired over the past 24 years. So to me, it makes sense to plant a few more seeds that can not only help provide some defense, but we do it in a way during deep market sell-offs where we're actually playing some offense at the same time. We're getting the cake and we're eating the cake too. And so beyond that general notion that Psi Capital has about diversification, let me go one level deeper and to tackle your question, Elliot, on perhaps different ways of creating diversification. We think about that in terms of not only business model, but also in terms of industries slash sectors. I typically prefer non-cyclical industries. That doesn't mean that we won't be in cyclical industries, but I typically prefer them. It just resonates more with me, and I feel, whether right or not wrong, that I have a higher degree of comfort in the ability to figure out intrinsic value. But beyond looking at less cyclical industries, I do like to diversify across various industries. I mean, we're in multiple industries, and I like to think about different business models as well. And by that, I mean we can have scale economy shared business models. We can have more traditional business models. We can have perhaps business models where pricing is not fully flexed. We can have asset-light companies, which we prefer, but we might also have some asset-heavy companies. So I think you can't screen for that. There's no screen that says find me, a scale economy shared business model or an asset-light business. You have to do the deep work, but it's there, right? It's created like an artist would paint a painting little by little.
Do you think that is even more advantageous in this disruptive age of AI where, you can actually screen for things very broadly and simply, and here you need like a human touch to do it?
Yeah, for sure. Absolutely. There's no like my late dad said, there's no shortcut. You have to do the deep work.
And with diversification, right? So you pursue more diversification when things are really beaten down. I guess with holding things, you just let the portfolio then concentrate itself when it starts working again, when we exit a bear
Oh,
market.
I love that question. I love that question because um, you know, actually I have to credit Saurabh Madan for my view on that. And you're totally right. So I kind of let the portfolio take care of itself. It was maybe Chuck Akre who said that optimization is insatiable. So we kind of figure out what we want the weight to be for each position, whether it's a new position we might take during a bear market or it might be a position we might take today. We figure out that weight and we kind of just let it run. In other words, don't cut the flowers to water the weeds. But further to that point, so Saurabh and I were sitting in this coffee shop maybe, or diner or someplace downtown in Manhattan when he was here maybe a year or two ago, and we were talking about exactly this question. And I asked him, like, how do you think about this idea of letting companies run in the portfolio, and how do you think about like structuring the portfolio? And he had this wonderful analogy about life insurance companies. So if you think about, let's say you're a life insurance company and there 10 people in the room, and you're asked to, let's say there are 100,000 people in the room, and you got to insure these people. Overall, you have a pretty good idea statistically with mortality tables to figure out like what to price that risk, right? 100,000 people. But let's say you want to choose just 10 of the 100,000. Well, now you're in a tricky situation where you may not, you don't have a large data set, a large sample set on your side anymore, right? And now you're kind of using your own intuition and your own judgment as to who of those 10 I should insure. And it probably is not going to work out so well. And so Rob and I were talking about this, and this idea when it comes to portfolio, maybe you don't have that ego, and you let your positions just kind of take care of themselves over time, and you don't behave like the insurance company who's going to try to be too clever and choose exactly which one you want to not pare back or you want to bet big on. Does that make sense?
Absolutely. And it gets back to returns per unit of stress. And it's the same reason why Steve Jobs wore the same shirt every single day as well. Like, you want to worry about the big questions, not all this minutia, and spending time thinking about the stuff that at the end of the day won't really drive a meaningful difference in your returns.
Yeah, and that's something like people I think overlook. There are a lot of managers who, they're like, they look through their portfolio and they say, oh, this should be like, this should be a 0.5% bigger. And maybe I need to increase this by 0.5%, and this needs to go down by 0.5%. But I don't think a lot of those portfolio managers are actually taking the calculator out and figured out, like, okay, if this company is going to do 10% a year and this company is going to do 13% a year, and I'm going to move 50 basis points between the two, what is the actual impact on the total overall return of the portfolio? It's pretty darn small, and it's not worth the headache, as you just alluded to. Like, that's not what Steve Jobs wants to spend his time on, picking the t-shirts, picking the small differences each day.
Also, Christopher, I think if you believe in power laws in investing, that speaks to this notion of kind of letting your winners run and get bigger over time.
Yeah, that's such a great point. Thank you for sharing that. And it's so true.
And maybe just related to that, power laws, it's been, at least in the past, I think, more thought of as part of the venture capital game. But it seems like maybe something has changed, where even in public markets, we are really observing this to a huge extent. And, companies have gotten much bigger than anyone thought possible maybe 1 or 2 decades ago. So, to what extent do you, in a way, see yourself as almost a late stage venture capitalist, obviously with that caveat of profitability? But, how do you think about that?
I don't feel like I have enough experience to consider myself anywhere near a venture capitalist. I have made a couple private equity deals other than investing in Brad's Express One business. The 2 private companies I did, one we actually sold to Meta. We sold it to Mark. And the other one we sold to another publicly traded company. The first one, in the case of a company called CrowdTangle, which we sold to Meta, Facebook at the time, we did very well on that. And the second one, we lost about 90% of our capital on that one. Both together, we did fine. But for the amount of stress and time and energy, I'm not sure it was worth it. And I certainly didn't feel like I added anything to the management teams of either of those 2 companies, simply because I don't think that I've had the experience in that area to be able to add value. So I don't think of myself at all as a late stage venture capitalist. But I do agree with you fully on the power laws and allowing these flowers to kind of grow. But the question then becomes, The question becomes, as a portfolio manager, what's your starting level, right? I don't know how you feel about that, John, Elliot, but if you are going to allow these positions to run and you're a PM, it's not your independent capital. What's your starting level, right? What's the position sizing in the beginning such that you can allow it to run without being forced by your investors or your own psychology for perhaps needing to sell off the company?
Yeah, that is one of the trickiest questions. Back to the trade desk days, I had a mentor who's like, I have tier 1, 2, 3, and 4 position sizes, never start ahead of tier 2, right?
Mm-hmm.
It's always tier 1 or 2. And as you learn what you're in better, as you get more comfortable, then you could go to 3 or 4 and let it scale to 3 or 4. But there's some kind of logical cutoff where when how it moves becomes how you move, you're starting to have a problem. That the portfolio itself should be the driver, and each of these are along for the ride. I have a harder time thinking of where the ceiling is. We've kind of put in constraints on ourselves, because certain clients, all of our clients to some degree, wouldn't be comfortable. Like they want diversification to some degree. Curious, yeah. What do you think? What's the biggest you'd ever let a position or an industry exposure get to?
Well, it was Brad Gerstner who recently had an interview, and he was talking about NVIDIA and how it's fine. Like if you had 1% in NVIDIA, but it really didn't move the needle unless you had, if you had 10% in it or something, or 20%, then you're really talking about moving the needle. So if you have a great idea, and great ideas don't come across very often, at least they don't for me, I think that you want to act in some size. So I can just tell you that I truly feel that investing is a very personal journey, right? It's so reflective of one's own personality. And I think that it will change over time. How your approach might change over time based on how you develop and how you learn from certain situations. And I've been doing this a long time. We have a 24-year track record now. Our approach hasn't changed that much, but it has changed enough. At least I notice it. Maybe other people don't notice it, but I notice where I've changed. And I truly feel that, that I like having these 20 plus companies, 20, 21, 22 companies. And I feel that in order for the power laws to unleash themselves, to fully take advantage of them, to invest in a position that I can truly benefit our clients through compounding, it can't start like at a massive number. I also like the ability to be able to add more capital if I don't have the entry timing right. Let's say I pay 100 and it goes to 80 in the next 6 months. I like to be able to add some capital. I don't want to feel constricted. I want to bring the average cost down. So I can tell you today, our largest position at time of entry is 10%. And when we took our position in Tesla in February 2020, we came in roughly around that. It was my highest conviction idea. Our average purchase price is $41.66. And today it's our largest position simply because, it's up so much relative to the rest of the portfolio. But we haven't trimmed it back. In fact, we've held that position the whole way. We've bought more for new client capital. And it's roughly 22% or so of firm assets as of this moment, give or take a percentage. So we just let it go.
That's so interesting. And, I'd maybe push back a little on Brad Gerstner on the 10% in NVIDIA. Having owned this 10 years ago with 3% of my portfolio. Man,
Well,
if only I didn't
you
sell.
were a lot earlier than Brad then.
Yes, I took a measly 50% gain and moved on to what I thought were greener pastures after getting frustrated with the Tegra chip, which I don't think a single owner of NVIDIA today even knows what the Tegra chip was supposed to do. How times have changed. But yeah, no, that kind of shows the power of compounding, getting something small very right. What could have been. And I had a thought and a question off of John's point about power laws. Like I was thinking that's something very real. Like the range of outcomes is much wider than it had been in the past. And, Berkshire, Buffett in the annual letter this year said something to the effect of markets are like more casino-like today
Mhm,
than they had been through his years.
mhm.
And I'm curious, like, do you attribute some of this to human behavior, or is it about how the range of possible outcomes for any given company is just that much wider today? And that means there should inherently be a little more like volatility and a little more room for momentum and herd-like behavior. Like, is there? I don't know. Maybe they play and connect with one another, but curious what you think.
Well, I think this part of your question goes back to this idea of disruption, which is just moving through our world at a much faster rate than it ever has. I mean, disruption goes back to the Stone Ages when stone was replaced by bronze, but the effect was not as amplified as it is today in other areas, right? So um, the range of outcomes as a result of the speed at which disruption is making its way through the world, I think, is just greater today. And so investors should definitely take note how they want to think about that and how they want to maybe structure their portfolio in a way that they can not only protect themselves from that, but take advantage of it. I will say that, but on this question, um, a number of years ago, I was. It was a funny story. Like I was in the Alps in not too far from you, John. I was in near Garmisch-Partenkirchen in Germany, and I had just started a summer holiday with my kids, and it was like Tuesday or something, and I was enjoying a nice hike, and my cell phone rings, and I get a call, and I was told that Charlie Munger is inviting me to dinner on like the Thursday. So can I be there? And so I said absolutely, and I told the family that I'm hopping on a nonstop to from Munich to LA. Fortunately, there was a nonstop from Munich to LA on Wednesday, and I arrived on Wednesday. And anyway, at this dinner on Thursday, I think it was a Thursday, Charlie said that Charlie said to me that it's in the nature of the world for the large to get larger. And I think that goes right to this question, Elliot, that you asked about, how this world is. Basically, that's the essence of the question. And, how do we think about that? And so large companies, I think, just have this propensity to get larger, but everything is changing so very quickly.
So, Christopher, in the age of AI, I'm curious, how do you think about both playing offense as well as playing defense in your portfolio?
Well, that is a question I'm struggling with myself. I believe that we own several companies that are at the forefront of creating value through AI in different ways. I believe we own several of them. I could be totally wrong. Um, that's the offensive part. On the defensive part, we've gone through the portfolio, and I believe that every position that we own is not in immediate jeopardy of being disrupted by AI. And it's something, your question is something that I think about every day. It's like the big question. And I haven't figured out how to invest in kind of a pure play manner in AI to benefit from AI. I haven't figured that out yet. Elliot was early on the NVIDIA, but I haven't figured that out.
Too early. Well, it's interesting because, going back to when you mentioned Google, right? I share your sentiments on Google. It's at any given day, it might be our largest position. It depends on the day. And it's AI is either the biggest risk or the biggest opportunity that Google's had in a very long time.
Yeah, and it remains to be seen. And so we own so to go to your question, John, about like the offensive part, the best that we can do at the moment, or at least I'm not smart enough to figure out how to do anything better than this, is that we have owned Google for a long time, so we continue to own Google. That's offensive, in my opinion. We own Microsoft, we own Apple, we own Amazon, and we own Tesla. And Tesla, to me, is one of those kind of optionalities which can wind up being a huge beneficiary of AI. Huge. And so we just going to continue watching the AI component of that, which is the full self-driving component. And we haven't priced it into what we think the stock is worth or where the stock is going. But it's just that it can be, it's kind of like this Zeckhauser component to Tesla, where Zeckhauser said, their big returns come from the unique, unknown, and unknowable. That's Tesla within the AI space. Other companies, though, I could see totally benefiting. Think about, I don't know how you guys feel about advertisements, but I kind of like ads. I kind of like watching commercials from time to time. And how great would it be if Netflix were just to give me the advertisements that I just really enjoy and that delight me, and use AI to try to figure out what to give me. So there's all these kinds of businesses where I think they could really benefit from AI and delight the consumer in the process. And they might not be so obvious. But Netflix comes to mind.
Well, that's one of the interesting things about AI, right? It's entered the popular conversation, but a company like Netflix, a company like Google, Tesla, they've been deploying AI for quite a while now, and they called it different things like deep learning, whatever it may be. But at the end of the day, it is very similar to what it is AI, right?
For sure.
Is there a big distinction between AI as we have it today and some sort of AGI where, potentially that brain can, create competitors to any company that is a digital business? I mean, we had recently, some startup, I think, created like the first AI programmer, that you can actually give a task to and you get a full, project done, essentially. Could at some point AI, create not just a programmer, but actual companies, a company that's created by AI that spits out CRM software that competes with Salesforce? I mean, is that too far-fetched when you think a decade out?
I don't know. What do you think, Elliot?
Oh my God, that's such a hard question. I've been reading this book that Josh Tarasoff recommended recently called Power and Prediction: The Disruptive Economics of Artificial Intelligence. And they introduced a framework that I thought was interesting in thinking about AI and how it will be deployed by businesses. And they broke down AI into they broke down phases of innovation, and they talked about electricity in the past, but how you have uh, first what businesses try to do, they look for point solutions, but when it really takes over, you get systems solutions. So the evolution from taking an old mill and transforming all the looms to ones powered by electricity on the spot versus building a entirely new kind of factory with like Henry Ford style. They're completely different, and one can become ubiquitous in the future, and the other is just something that's going to have some resistance, and it might have some success, but it won't be a transformative. And when they talk about AI and its capacity to build something like, an AI decides to build a Salesforce, they still seem to suggest, and I'm speaking about them because I don't know enough about this stuff to know if I could even answer it, that you would need a human to say to the AI, build me a better version of Salesforce or whatever, as the starting line in that query. Like, it has to be given some sense of purpose in advance of finding that. It can't just open-endedly go. Even an AI that passes the Turing test, it can't just open-endedly go and be like, what I mean, maybe the initial inquiry could be as simple as like, what are some businesses most ripe for disruption, and can you go build it to me? Maybe that would work. Maybe I'm rambling also, but I just, that seems a lot harder, like a much bigger step into the future, to have an AI that can just disrupt stuff that's in existence for a very long time.
Yeah, that makes sense to me. And so that's like us trying to figure out the offensive part, right? How to take advantage of the offensive part of investing through AI, or as a result of what AI might do for its shareholders, the Amazons, the Apples. There's also the question of, I mean, going back to John's point about maybe looking at the more defensive side, maybe the real beneficiaries are, I mean, it's like the analogy is the gold rush, right? With picks and shovels in versus the gold diggers who made the money. And so maybe we need to be thinking about things that way. Maybe it's the energy companies, maybe it's the data centers, maybe it's something else.
That's
And
where
then
I think
and then
Google.
what's
So
and what are we paying for all of it too? I mean, that's like a pari-mutuel, investing is like a pari-mutuel race, pari-mutual betting. So how much are we paying for each particular path? What makes sense?
that's where I think Google's so interesting, right? Because they are trying to build like Gemini or FKA Bard, but they also are building amazing infrastructure. So even if they lose with Gemini, they might win with building the best infrastructure that other people will build the AI on. But those questions are inherently tough. And the path, like you've mentioned several times, it's not linear. Like, if they lose on the point on the platform side with Gemini, I don't think that would be viewed very favorably before they get to prove out that their infrastructure is the one best suited to serve others' needs.
Yeah, for sure. Um, it's so going back to this talk that I gave called "Investing in an Age of Disruption." Um, and this is so applicable to the time that we live in, this rapidly changing world. And it's so applicable when we're talking about rapidly growing companies. As investors, and even as value investors, we just have to get over this idea of physics envy, right? There's no, investing is not like physics where we can just get down to the to the third decimal place and try to understand something, there's this area of gray. And so, as I mentioned in the talk, we just have to get used to dealing with shades of gray increasingly as the world becomes more dynamic. We have to get used to dealing with these shades of gray. And how do we do that? Well, we have to do it, of course, within what we think is our circle of competence. And we have to do it by always building in a margin of safety to every investment that we make. So I think that the underlying framework about how to invest has not changed. It's the same. It's about getting more for your dollar than you're paying. And it's about being humble and understanding that you may be wrong. You're very likely to be wrong. And so there should be some diversification, and we can all debate as to how much diversification. But there absolutely needs to be a margin of safety, particularly because the world is so dynamic. And so these fundamental traits haven't changed, even though the world is getting more dynamic, even though there's so much disruption happening all around us. And there's this, are any of you familiar with, Elliot, you may be familiar with Bill Evans. John, maybe? Bill Evans?
I'm not, no.
No.
So
Sounds
Bill,
like I should be, though.
well, I thought you were involved in music for some reason, but Elliot.
I am. I love Fish, the jam bands, that sort of stuff. But I see a jazz pianist.
Yeah, so Bill Evans was an American jazz pianist and composer. And my friend David introduced me to an interview that he gave called "The Creative Process and Self-Teaching." It's a really cool interview. It's in black and white. You can pull it up on YouTube. I'd highly recommend everybody who's listening to this to check it out. The Creative Process and Self-Teaching by Bill Evans. And during this interview, he says something really, really interesting. I'm going to quote it. He says, "You could be too cautious. You could be cautious to the point where you never discover anything. I think you have to have a certain adventurous spirit." End quote. So he was talking clearly about music, but I think what he said is so true about investing as well. And if you wind up just trying to find something that might look right to you from a valuation standpoint, it's probably been like screened over a million times. And there's probably no alpha there just because everybody is looking for the same stuff. And so in order to create any alpha, I think, just because how information is just so rapidly disseminated and everybody is looking for the same thing, they don't want to actually do the deep work and put the hours in. But I think that you need to do that. And I think you need to have this kind of adventurous spirit to perhaps look at things where look at businesses that other people might just rapidly dismiss because they look expensive. I think that's where it's interesting. I think that's where a lot of value is, where a lot of value often resides, is in these companies that appear expensive, but they actually aren't. And they actually aren't because so many people dismiss them, and so the capital hasn't flown in fully. I'm truly interested in companies that continue to go up, like the share price appreciation. I'm not talking about a year or two, but I'm talking about companies that continue to go up over 10 years. But they've looked expensive. I'll give you some examples. Like Fastenal Company was one of those businesses that I think Barron's wrote about it as an ultimate short or a short case. But the company continued to go up every year, and there was a reason why. They had created this massive economic moat. So I'm interested in those kinds of companies, and I think that that kind of process aligns with the curiosity that I've had since I was a kid. I like to look where other people maybe have not looked. But at the same time, you have to be super, super cautious about buying multiple companies and make sure you really understand what's going on under the hood.
So, Christopher, to what extent does sentiment, investor sentiment, play a role in your process? Do you actively seek out those kinds of opportunities where sentiment is negative, and do you avoid stocks where you feel like every other taxi driver is talking about that company?
Sentiment changes, as we know, pretty rapidly, right? And our research process often spans a number of years. So for us to go and make a move based on to formulate an idea based on sentiment, that doesn't really work for us, just because we're going to be looking at a company for quite a while before we even act. We will use sentiment, though, often as the catalyst to make that initial investment when the market might be super concerned about something and the share price gets crushed. That's when we will swing, and we'll swing hard, like was the case with Tesla in February of 2020. But typically, I'm looking at these businesses way before we actually make an investment. And one of the things that I'm looking for is, it's hard to explain somehow. I think, there's this Josh, speaking of Josh, Josh is close. Josh Cherosov's a close friend of mine, and he had this wonderful essay on implicit versus explicit conviction. So what I'm looking for is this some sort of explicit conviction. There needs to be something there that resonates with me and resonates with consumers. I think that's sometimes easier to find than not. I think often is the case, it's pretty obvious.
Yeah, that's really interesting. I mean, it's a little bit Peter Lynch insofar as like to resonate with consumers. You as a consumer could get an appreciation for some of these pieces. Though obviously, a company like Fastenal, that's a little different. We'd not really know the customer mindset, but you could see something pretty clearly that manifests through the numbers over many, many years.
Absolutely.
And we've been talking a lot about disruption. I guess one of the things I wonder about, and I know it's not directly related to investing, but you do a lot of thinking outside this, but like, should we as investors care about how disruption plays out socioeconomically and politically? Like, should we be thinking about that?
Absolutely. I'm so happy you mentioned that. So disruption, when we've been talking about disruption today, we've been talking solely about businesses. But disruption happens in many different ways. So let me give you an example. And all disruption, by the way, happens along S curves. So it's important to understand that, because from an evolutionary standpoint, our brain is wired, right, to think linearly. But disruption follows an S curve. And part of that S curve is highly exponential. So what happens is that in the beginning, like any sort of disruption is kind of slow to take off, because it'll have a limited share of the market if we're talking about a product or a service. But then there's this tipping point, and then you get this kind of exponential phase. And it's super interesting that if you go back and you look at, go back to like the 1400s, 1440. In 1440, the English and French were coming to the end of their 100 Years' War. And there's this guy by the name of Johannes Gutenberg who invented the printing press. And people didn't really pay much attention to this printing press, but it unleashed a printing revolution. And that printing revolution took hold at a speed that was super, super quick. And it had profound implications, right, for so many areas of the world, particularly for the the Catholic Church. And the same kind of speed in which disruption took place happened with the spinning wheel, the steam engine, the automobile, cable, more recently streaming. All of these products and services were adopted very, very rapidly, all within 20 years, all despite widespread initial skepticism. So those are the products and services, just to give your listeners a kind of sense of how disruption has moved through the world over the past several hundred years. So jumping to the 1900s, the Henry Ford comes out with his Model T in 1908. People thought like this is not going to catch on. I mean, there's a magazine called Carriage Monthly, and Carriage Monthly in 1904 said that humankind has traveled for centuries in conveyances pulled by beasts. Why would any reasonable person assume the future holds anything different? Can you believe that? So, but of course it did, right? The future held something very different. The automobile was rapidly adopted. It went from like 5% market share or 5% of the vehicle fleet in 1905 to 95% 20 years later. So again, 20 years basically. And at the same time, governments got very interested in the adoption of the ICE vehicle, despite, by the way, no paved roads, no fueling stations. People had never used the product before. They had trusted the horse and carriage for many years. So this all happens within 20 years. And governments get very interested, and they come out with a gasoline tax. So Oregon was the first state to introduce a gasoline tax. They introduced it, I think, in the year 1919, and it was like 1 cent a gallon. But within a decade, within 10 years, all 48 states, there were 48 states at that time, all 48 states in the District of Columbia followed with their own tax. So this is an example of disruption being not limited just to products and services, but to things like policy innovation. Pretty interesting. So we should think about disruption happening not just in business, but in other areas of our life. And those other areas, incidentally, can have tremendous effect on how we live our life.
I'm curious, Christopher, to what extent do you think about disruption in the health space? Because that's something where I feel like we may be on the cusp of a real, major change where, great things will happen, and there will be companies that are going to be extremely valuable because of what they will bring to humanity.
Yeah, I think it's so exciting. And I haven't figured out how to invest in that area, but I can see the alignment, right, of AI and healthcare and disruption coming together, creating better health outcomes for everybody. Super interesting area. We should, the three of us should talk about that at some point.
Sounds great. Elliot?
Yeah, no, I agree. That would be really interesting to dive into.
And you're so versed in the healthcare space, Elliot. Like we should definitely have this conversation, the three of us, and you bring in all of your knowledge about biotech companies and pharmaceutical companies, and maybe we can figure out how to, link that to this world of AI.
Yeah, I've been thinking a lot of it in terms of like convergence that you've been talking about, how there are several of these, I'd say, profound innovations that are coming together in, for lack of a better phrase, a Lollapalooza effect, because you have like genomic sequencing, right? That was a really major innovation, and on its own, it's been incredibly disappointing because it's been really hard to harvest the fruits of it. But as it gets cheaper and cheaper, we're building this massive trove of data. We're learning a lot more about how genes interact with one another, and we're learning a lot more about how specific genes express themselves. But with AI, that gets so much easier and so much deeper and way better. And it drives amazing efficiencies. And then on top of that, 10 years ago, like society didn't know what CRISPR was. Like we didn't know we could literally edit genes and change the way people are on the most basic fundamental level. So you combine AI, CRISPR, and genomics, and suddenly you have something that's incredibly interesting. Like no one of those on its own could really do anything without the others coming together. And I think it's one of the themes that I've been really getting myself excited about the future and what it means and how it could change outcomes for people, people that I know and love really, who are really close to me, who have like specific genomic based problems. And, you know, people like now we have an actual cure for sickle cell disease on the market. That's such a really challenging thing for so many people to deal with. And yet here we are. Obviously, the cure is not necessarily an easy process. You have to go through something called conditioning, which is basically chemotherapy. And then you're able to undergo the genetic treatment. But it's, I don't know, it's wild to think that we have these tools in our hands today.
Super wild, right? Super wild. And every day we have so much negative news, right? We wake up and we read all this negative news, but I try to remind myself that we're very lucky, right, to be living during a time where these technologies are converging and making the lives better for so many people. But I love this area, John, of healthcare and trying to figure out how to be investing in the right way. There's this great book. I don't know if you have read it, but it's called Black Box Thinking. I highly recommend this book by Matthew Syed. I think his last name is pronounced Syed. It's Syed. And in this book, he talks about how there was a university in, I think it might have been NYU. My mind is not fully recalling which university, but I think it was NYU. And there were there was a study done, and there's a bunch of MRI scans given to the people to look at. And then they were removed and given back the same scans, given back to the same group 6 months or so later. And it was surprising how the initial diagnosis or the initial analysis of the scan differed from the analysis 6 months later. And that to me is just unacceptable. And I'm hoping that AI will fix that very quickly.
Likewise. Well, it's certainly a fascinating area. We should reconvene on that at some point. On that note, we will leave it there. Christopher, this has been so wonderful. Thank you so much for all your wisdom and insights. We've truly enjoyed it. Elliot, maybe a few last words from you as well before we let Christopher say a few parting words as well.
Yeah, this was awesome, Christopher. Thank you so much for joining us. I've learned so much from you over time. I was lucky to be there in person when you gave the lattice work talk, and I'm really grateful that you joined us and for sharing your wisdom with our audience here.
Well, I'm happy you didn't fall asleep. It got to be a very long talk. But,
it was perfect. It really was.
This has been amazing, and it's special for me to do this kind of thing with friends as opposed to strangers. And thank you for the interest, and thank you for having me on. And it was great to hear both of your voices. And I hope this is helpful to MOI and whoever else is listening.
Wonderful. Thank you so much, Christopher. And thank you all for listening. We'll be back with the podcast in short order. I hope you enjoyed this episode. Goodbye for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.